to a really great financial future. Tom and Don are talking real money.
There's a lot of advice out there floating around on the internet, in the occasional printed publication, which, of course, Tom loves. He loves anything that kills trees. He's a big fan. There's a lot of information about investing, how you should invest, particularly for retirement. And a lot of that advice comes from people with a questionable motive, particularly when it comes to annuities. We are not big fans of annuities. Let's just start with that. Generally speaking, if we're going to go broadly, we're going to say, not the best idea most of the time. However, there are times when an annuity might make sense. And to that end, we recently read an article from our friend Christine Benz over at Morningstar entitled How to Buy an Annuity. And we thought we would, comment on her position on annuities, what she thinks you ought to be doing when it comes to using annuities in your retirement portfolio.
Yeah, and she had done a piece earlier about is an annuity right for you? Both of these are available free, by the way, at Morningstar. So you could go read first, is an annuity right for you? This piece was about sort of once you've made the decision that it is, how to go about buying an annuity and what money to use.
Let's start there, though. Let's start with, is an annuity right for you? Is it? How do you determine that?
Yeah, I think a couple of ways. First of all, what an annuity should be designed for would be filling in income from fixed income. Let's assume that you have a source, at least one source of fixed income in retirement, that being Social Security, right? Okay. Some people, I think it's 20%, have a pension as well. So now you've got two fixed sources, right, that are supplying a certain amount. Oftentimes, there's a difference between that amount and the amount of money you're planning on spending or already are spending, right, that needs to be filled. Now, many people say, I really liked the whole thing when I was working where I was getting a regular paycheck, and that was covering the bills, right, and the trips and et cetera, et cetera. So they're looking for a way to do that is easy. It handles it, and I don't have to think about it. The money comes in.
So basically, people want to buy into their own pension.
Exactly. So, and the way to do that for many people, I can say it's many people because I still can't believe this number. The expectation is more than $450 billion with a B in annuities will be sold this year. 450. That sounds like $500 billion. It's a lot of money.
Well, look at you, Mr. Math Wizard.
How about that? Adding it all up. So that's basically the reason why you should consider one. Now, the reason why people buy them, I think, is they hear an interest rate. This is, when they call me, they say, "Oh, I'm making 7% on my annuity." I said, "No, you're not." "Yes, I am." That's what they told me.
I'm getting a 7. I put $100,000 in, and I'm getting out $7,000 a year. That's 7% by anybody's math, including
and they
Tom's.
Think they're making that. That's what they think they're making. That's not what you're making. That's what you're getting. And by the way, some of that money's yours is coming back, and a little bit's theirs.
That's a point we're going to get to. Yeah. That's a point we're going to get to, because when you switch over to, now we understand why people want an annuity, because they want a regular income that's predictable. Got it. But there are trade-offs. Now, in the next article, Christine delves into how you choose an annuity. And this is where the waters muddy dramatically.
For me, very dramatically, because in the piece, and by the way, the top seller, you'll be glad to know this year, the expected top seller in annuities is the ever popular, never seeming to go away, despite however many bad things we say about it, the fixed index annuity, which
is it still the number one
it's
annuity?
Number one,
even though the only.
Okay.
I'm gonna hold back for a moment
because there goes the show.
I'm gonna sit here quietly, wait for you to fill in the gaps here at the beginning. Tell the story.
Christine Benz goes through where the money would come from, right? And sadly, I see a lot of people buying an annuity with what we call qualified money, right? A traditional 401k money.
Buying it in their IRA or their
IRA.
401k.
I
or
don't
their 403B.
like that.
Yeah.
Because you're getting tax deferral already in your IRA, and you're kind of paying for that when you buy the annuity. But she does go through, does it make sense to use taxable assets, right? These are like brokerage money that you've saved outside of your retirement, or qualified money, which I just described. And then she launches into a product that, for some reason, I always forget about these. Maybe because I want to. The QLAC, right?
Sounds like a commercial for insurance that features a duck. QLAC.
I think you should. I'm trying to remember what that stands for, too. The Qualified Longevity
Annuity Contract. Yeah, longevity
QLAC.
annuity contract.
Which
QLAC.
the only benefit I can really see from this is you're able to defer your required minimum distribution. In fact, this year you can take $210,000 of your qualified money, put it in this QLAC that will enable you to defer taking the money out and paying taxes on it until at least age 80.
Well, up to age 85. You can take it out at 70,
you can start
72, 75. You can start it anywhere along the way. You can pick any point at which you want to start. But the longer you wait, the bigger the payoff is from the insurance company. I wonder why. Why would they pay you more at 85 than they would pay you at 75? Because you're more likely to die.
You may or may not see the daylight at 85.
And here's the thing, that she glosses over this part. When you put your money in a QLAC, in a qualified longevity annuity contract, you are giving your money, basically in the most basic form, you are giving all your money to the insurance company for a promise that they will start giving you an income, a fixed income, at a stated date in the future. But the money is no longer yours unless you accept lower income or you pay for a rider that gives you a death benefit, which is just complexity added on to complexity. QLACs in and of themselves are a guaranteed way to give all of your money to an insurance company should you die before the age at which you start taking income.
And what happens if you die before you start taking income?
They keep the money.
Now, can you buy a contract that says if I die before the income, you just pay a little extra for that?
Yeah, but then you're going to get less income.
Okay. Yeah.
So there's always a trade-off. The insurance company will not lose. They can't lose on a deal like this. Maybe if you live to be 132.
It pays off for you and not for them. So
Odds are against that. I'm telling you. Let me tell you right now, Elon, even you, Elon.
I don't want to see 100 or 132. No offense. So again, in my mind, and I wish it was more straightforward with hers, I would only use taxable, as I said, brokerage assets, savings, et cetera, to put into an annuity of any kind.
Yeah, but the only kind we'd really suggest is the single premium income annuity, the SPIA.
And describe what that is, right? That's putting
an
it in
annuity
and getting
where you
started.
give them your money, and then they promise you a certain paycheck right away. Immediate annuity. SPIA is a single premium immediate annuity. So you give them $100,000. They say, we're going to give you 7% a year. They give you that $7,000 every year. Now, you've given them your money. If you don't live long enough, you lose, they win. You don't have any control over your money. You can't get it back. You can't give it to your heirs. That's very similar to a QLAC, a qualified longevity annuity contract. And let me just tell you a little bit about, for example, a QLAC, if you funded it at age 65 with $100,000 and you said, okay, I want income at 80. I'm going to wait. This is going to be my long-term lifetime income. If you wait until 80, they're going to pay you. Get this. It sounds really, really.
There's $100K going in.
I did the $200,000, which is the maximum. $200,000 at age 65. You put it into the QLAC.
15 years later.
They say if you wait till 80, guess what we're going to do? We're going to give you $35,000 a year.
Because they know you don't get that many years. Basically, at the end of the day.
Remember, they had the money for the last 15 years. Now, if you had just kept the money for the last 15 years and invested it at 6% per year, lower than a balanced fund, pretty conservative portfolio, you would have almost $500,000 at age 80.
Which at 80, you could certainly take out 6% and pay yourself the 30.
Let's assume
be a problem.
Let's assume you're earning, if you continue to earn 6% and you take out that $35,000 a year, then you will have enough money to live until about 110.
Yeah, you should be good. Again, so this goes back to why we're not big fans of annuities in general, and specifically anything certainly outside of that immediate, because while you're getting the guaranteed income, while you worry less, while you have no market volatility, you have no liquidity. Mm-hmm. You really have very little transparency. You have the additional expenses, and you have the risk of the insurance company, right? This is only as good as the insurance company. That's a given fact. So, okay. But assuming that you went back and read Ms. Benz's earlier piece, assuming you've looked at your retirement income, you say, I really want something that's going to supply the income here, and you've decided that this immediate annuity makes sense, where, my friend, do you go to get one?
A single premium.
You can't go to Starbucks, I don't think, right, and get it with your latte.
No.
Where do you buy it? Because she doesn't talk about this in the article.
Here's the problem. Annuities are sold by insurance companies. And so you can't really get these products through anybody but someone who's licensed to sell insurance. So and it becomes very, very difficult to shop for these because the insurance industry is known, as we mentioned earlier, for opacity. They're not big on transparency. So finding a place to buy them where you know you're going to be treated right and get the best deal for your money.
There's no clearinghouse like there is for other types of insurance. You can go comparable, make comparable sales.
I would say you probably stand a reasonably good chance of getting one through some of the bigger brokerage firms like Schwab or Fidelity, because they're going to have a lot of annuities from which you can shop. I would,
and they're going to only work with the best carriers, right?
Right. They're going to work with great carriers, and they have tools that let you shop. It adds a level of safety and transparency that you're not going to get if you go to the insurance company's captive agents directly, like a Northwestern Life agent or whatever. You're going to get a selection. You're going to get an ability to shop. There are some independent annuity marketplaces that I've never dealt with, so I cannot tell you how good they are or not. Things like immediateannuities.com. But if I was looking for one, which I'm not, but if I was, I have an account with Schwab already, I would probably go to their annuity marketplace and shop through there.
And can you shop at a place like Vanguard, for example? Do they? Because I think in the past they have had annuity.
I think they do
products
because they're a brokerage firm.
So they're going to have that available.
Everything's
to the
brokerage,
folks.
And I'm pretty sure. Let me just check their website and see. They actually have a separate platform, which I don't know anything about. It's from a company called Income Solutions.
Somebody they're partnering with.
Yeah, somebody they're partnering with. It's called Vanguard Annuity Access.
But again, there you get the credibility of working with a major firm that's likely to only work with the best carriers.
Right,
et cetera. So.
Right. But I looked up Fidelity's tool earlier, and their annuity search tool is actually very robust. I did not look at Schwab's, but I know they have one. So since I'm with Schwab already, I would probably go through Schwab if I was looking for one.
But again,
the thing is, we mentioned this earlier. The most popular form of annuity out there is the equity indexed annuity. These are the worst kind of annuity out there. They are the highest commission annuity out there, which should tell you why they're the most popular. Because there's the most incentive for agents to sell them to you. The only annuity that will buy you a steak dinner is an equity indexed annuity. That's not coincidental. It's because they make so much money on these. They can make on $100,000, just $100,000 annuity, the agent can make between $7,000 and $10,000 in commissions, or the agent and the agency through which they're selling. That's a lot of steak.
Great afternoon.
That's a couple of cows.
Productive meeting. So, yeah. That's one reason we don't like them. Number two is we don't like the promise they make. And number three is the actual performance, of which we have looked at from time to time, is certainly not market-like returns. Let's just be fair about that. So.
It's nothing like what they pitch.
And I know today's world, it feels like I really don't want to watch the market go up and down depending on the price of oil and war and interest rates and politics and the rest of it. But you have been paid for just allowing that to be the background and getting on with your life. But
and it's funny. One of my favorite questions from listeners and others that I talk to about money, and I talk to other people about it because of what I do. One of my favorite responses when I tell them about these annuities is, "Well, how can they say you get the return of the market? How can they say that?" And my answer is, people lie. People don't tell the truth. And they cover their derriere by giving you, if you buy the contract, they give you disclosure documents, and they can say, well, it was in the disclosure document.
You actually had to read the disclosure document.
You would have had to read the 200-page disclosure document.
How many
people
of you just
don't
even read them
cover to cover?
Yeah, no, very few, and
very
fewer
few.
Yet, very few, and fewer yet read disclosures on those documents. So there you go. Got to have an annuity. We gave you one.
No, but generally
Not
speaking,
that one. So,
you most of the time you just don't need them. If you have any kind of discipline, if you have any kind of structure in your life, if you can create an income stream from a portfolio of about 4 or 5, maybe even stretch it and go 6 if you're a little daring a year, you can do what an annuity does and keep your money. It's called, that having your cake and eating it kind of thing.
Yeah.
You can actually keep the cake and eat some of the cake. And the cake might even keep growing. That's even better. How can you have your cake?
I want that cake.
And it gets bigger and you're still eating it.
Here's the thing. Generally, when it comes to me and cake, I get bigger, the cake doesn't. Well, what you're saying in this case is
this cake would actually get bigger while you were nibbling on it.
Nibble would be okay.
It's a magic cake.
Yeah, it's a magic cake. That's a whole different cake we're talking about then. So.
Now, ladies and gentlemen, we are coming to the most exciting part of the program for Tom.
When I depart? Oh, sorry.
No, it's the tree-killing segment of Talking Real Money.
Keep that on the DL. That tree limb tried to kill my wife
turning
recently.
it into bleached paper. At least you could use unbleached paper.
Well, that's not available here, so I'll put in the request, though. I'm sure in 3 or 4 years they'll let me know.
Do they even? Can you get unbleached paper I don't think so.
I got to try it. All right,
I think they call it toilet paper. No, even that's bleached.
Please, we really need more questions. We really need more questions.
Tom says he needs more questions.
Yeah, so please. And by the way, you can call us like you used to in the old days on the radio show, 855-935-TALK.
Yep, you can.
We take your questions there. You can call all kinds of other ways. Call Don's special Friday
No, you don't call my special Friday thing. You go to talkingrealmoney.com and you click on Ask a Question.
Okay, but you can send them in by typing, as Don likes to say.
Tom likes typing.
And this one comes from Athens, Illinois.
Georgia? Oh,
Athens,
darn it. I had the wrong state again.
And I'll be in the other
Des Moines,
Athens
Iowa,
this summer.
And it was Des Moines, Washington.
You can start picking on me now. Athens, Greece, where I will be this summer.
Another vacation.
I was trying to set you up here for the easy one.
Sir, aren't you taking a vacation like this in April? Or you've already taken. You're back.
I know. Sunny.
I forgot you were. I didn't even miss you. I hardly knew you were gone.
How about that?
How can we miss you if you won't go away? You, on the other hand, how can we know you're there if you keep going away?
Exactly. Bryce writes, hi there. 30 years old, 3 accounts at Edward Jones in their Guided Funds Solutions account. You can look that up while I'm talking here. Guided Funds Solutions account. As I began learning more on investing and its details, I've realized the fees at Edward Jones are very high. Considering moving those accounts to Roths and one simple IRA to Vanguard, I'm confident I'll be fine, but nervous on selecting my assets and getting the correct asset allocation. What would your recommendation be? And is it smart to move out of the Edward Jones program?
Yes. There you go. Just absolutely yes.
And by the way, you can get any, and Bryce, you're 30. So you can get any fund you need at Vanguard, any exchange-traded fund. So this is pretty easy.
Yeah, and by the way, my guess, and let me guess. I'm just going to guess. I'm going to guess that in the guided solutions
Guided
account,
funds solutions,
guided funds solutions, now they're using one of two mutual fund groups. Okay, you ready for my
American
guess?
funds would be one guess.
Oh, good one. Do you know what the other one is?
I don't really.
Okay, because this is proprietary. The bridge builder funds.
Ah, yes, those have become more popular in recent years.
Well, yeah, because they're proprietary.
And they're selling them.
Yeah, and they actually have, even though they're actively managed, they have much better expense ratios than the American funds. So they're very competitive, but they're still actively managed.
Traditionally active.
Yeah.
Yeah.
Yeah, they're
picking stocks,
active.
figuring out what direction the market's going, that kind of good stuff. So,
but 20 basis points is really shocking.
That is shocking. So, yes, I would not keep my money at Ed Jones, and not necessarily for the fees, although, yes, they're going to be higher, but because you're not going to get treated to 100% protection of a fiduciary advisor. Ed Jones decidedly not that direction. So that would be one. But in your case, Bryce, that's pretty easy because in a Roth, you should probably just have one fund. You could have AVGE or AVGV. Either one would be fine.
How old is he?
30.
30. Yeah, that's
you got a long time until retirement.
That's an aggressive age. You can be very crazy aggressive.
I mean, you could almost do the same in your simple IRA, but if you had to have bonds there, you could have a balanced index fund of some kind, but you could do one fund for all three of those accounts at a very low cost and be very well diversified, and the upside tremendous. So, yeah, I'd move. I'd go to Vanguard. That's fine as your custodian and buy one of those one-fund solutions. So,
well, and I'm looking. This is really funny. This just shows the performance of active managers versus just indexes. Over 10 years, the large cap growth fund at Bridge Builder, which is going to be similar to the S&P 500 or similar to the S&P Growth Index, the S&P Growth Index has done 15% per year.
Wow.
Over 10 years?
Yeah.
On average, over 10 years. This fund has done 13%.
Shows you right there.
And that's not expense ratio. That's just not matching the market.
They're buying and selling stuff, telling you what's coming next. So that's an easy one, Bryce. Well done. From Pensacola, Florida, Michael writes us, love the show. You guys back a traditional investing philosophy and have for decades. You readily admit you're hesitant to change.
Mm-hmm. We say that all the time, yes.
Sounds like my ex-wife. This evidenced by your slow transition to ETFs. That's true.
Took us a while,
slow.
Yep.
And now finally ditching the radio, which is true.
The radio still has a pretty good audience. It's just we wanted our weekends back, but okay.
Which most have done so already in favor of dedicated podcasting. Better late than never. In that vein, it appears you're late to cryptocurrencies. Yeah.
Oh,
you still push bonds for stability.
There's nothing there.
No, it gets better. This gets better.
Okay.
You really should take the time to see what strategy is doing for the financial markets. Capital is flowing from traditional assets, bonds included, to strategies perpetual preferred STRC. For stability and security, it's collateralized by 5 times with Bitcoin and cash. It strives for and has maintained consistent stock price of over $100 in its lifetime. Its annual dividend yield currently 11.55 paid monthly. It's maintained this dividend even though the current Bitcoin winter, where Bitcoin price has dropped 45%. This product is appealing to the small investors like me, to the institutional and nation-state investors needing stability as well as the increased return. It has a Sharpe ratio of over 3, significantly better than QQQ, Gold, BND, NVIDIA, Google, etc. Would love to hear your thoughts on this groundbreaking offer by Michael Saylor and Strategy.
Strategy, this is their preferred stock.
Yes, correct.
Of Strategy Incorporated. This is it's going to, hey, if Bitcoin is going up, they're going to make money. If Bitcoin plunges for a long period of time, this thing's in deep, deep, deep trouble.
It can't pay the 11.55 then.
Well, of course not. 11.55. This is it's how do I describe it? It's a gimmick. That was the word I was looking for. It's not a bond. Okay, so please don't compare it to bonds. It's not a stock because it can't really grow. If Bitcoin plummets, it's going to plummet. I can guarantee you if Bitcoin, it can only do as well as Bitcoin does. And strategy has done, the strategy stock itself, look at that. That's going to give you an idea where this thing is going to go, because strategy has in the last, let me just pull up the longer term numbers here. I'm sorry, I should have had this, but I didn't have the question in front of me.
Yeah, I apologize. You're supposed to give
January
it
of 2026.
Yep.
Strategy traded for $178 a share. Used to be MicroStrategy. Right now, MicroStrategy, when we recorded this a couple weeks ago, MicroStrategy was trading at $130, less than $130 a share.
Message received.
STRC is going to hold up a little better because of the perception of safety from that dividend. But that dividend is unsustainable if Bitcoin continues to decline. I mean, they've held their value, but the reality is, and this thing has fluctuated a little, it's held its value really well only because of the dividend. But that dividend cannot be paid if they run into trouble, if Bitcoin runs into trouble and the value of their assets goes down.
Which is worrisome. More worrisome to me
scares the heck out of me.
Well, which is more worrisome to me is bond replacement strategies. How many of these have come along? Many have come along. And many compare themselves to U.S. government bonds, which, has really done pretty well at paying back the people that loan them money at the aforementioned interest rates. The full backing and credit of the U.S. government is substantially better than cryptocurrency. I don't know how else to say it. So I wouldn't bank on them as a bond replacement strategy. Number two, for me, just looking at this from the high level, anything that's paying 11.5%, there's got to be a risk attached to that. It just has to be. So I'd be very careful, Michael, with something like this. I would not use it for bonds. I guess you could use it for a speculative play of some kind, but it wouldn't be something that we would use nor recommend. I'll put it that way.
I mean, if you're going to do the speculative play, then you do MSTR. You do just strategy stock.
Correct.
And I let me tell you yes, we were late to the ETF game. That is we still like the idea. We just weren't sure how it would hold up in a bad market if the market makers walked away.
Because we'd seen the bottom fall out. Yeah.
Yeah, we saw it during the flash crash many years ago. So this is different. This is structurally massively different. This is an asset created on an asset that was created that really still to this day I do not believe has any reason to exist. That's my fundamental belief, and I cannot imagine that belief will ever change. Ever. Because of the lack of logic. There is no logic behind cryptocurrencies. There isn't any. None. Not as an investment.
Not as a currency.
Not as a currency.
I mean, other than that, it's like
I still don't know what it's good for. It's not digital gold because gold has a physical form and shape and use. Crypto still doesn't have a strong, okay, you can make your little baby El Salvador use case. That's not a real use case. It has no real use case. Your only use case is if all the fiat currencies, air quotes, collapse completely. Everybody's going to go to Bitcoin, right? I mean, what? There's nothing there. There's nothing there. This emperor really is walking down the street naked, this currency. I think it's naked.
You can't wrap it around
and no
your
one
finger
wants to
either.
No, and everybody's afraid to say anything because you guys, you crypto bros, are so rabid in your defense of it. You're truly rabid about it. your arguments are spurious, and I'm going to get another bad review.
Yep. At least one.
I guarantee it.
Yep, it's coming.
And the fact that if you notice, most of the bad reviews we get, some of them are about the fact that we're old guys and out of touch, which I kind of think follows. Most of them are about our dislike of crypto. Tom is more afraid of you than I am.
Tom's just more afraid than you are.
Yeah, Tom doesn't want to come out and just say it as bluntly as I do.
Anything for that matter.
But there's nothing there. This is a big nothing.
Yeah.
There's nothing there. And the perfect example of nothing there is every other crypto that isn't a stable coin. Dogecoin. Oh, come on. Really? A joke doggy coin? Okay, I'm done.
You're going to go on. So thank you for your question. Thank you for listening. And the answer to that is
not the same as an ETF.
No. That's a whole different topic. All right. So speaking of topics, if you've got some, we'd love to discuss them.
Questions, you mean?
Oh, questions, topics, concerns, anything. We're happy to take them. And there's a number of ways you can do it. As Don just said, you can go to your computer, go to talkingrealmoney.com, and you can record a question right there. It's that easy.
Yeah, it says ask a question. You can see it in the button area.
If you want to join me in taking down those big trees, you can type a question. Mm-hmm. Yeah. Or you can call us, 855-935-TALK. Any of those ways.
Each question gets printed on a piece of paper and then printed on 4 more so he doesn't lose them. He says, quadruplicate.
Because the tree limb tried to kill my wife. And so I'm coming after you guys. And if you want some one-on-one help, you can go to the same aforementioned talkingrealmoney.com, click on Meet an Advisor. Happy to do it. Yeah.
You have it right there. Oh, and also you can call in your questions at 855-935-TALK, 855-935-8255. So ask away and listen every day. Oh, that was poetic,
good,
wasn't it?
I'm telling you what. Wow.
Ask away, listen every day to Talking Real Money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.